Hello everyone, welcome to my channel. I hope you all are doing well. In today's video, we'll discuss about principle of accounting, that is concepts and conventions of accounting. So let's start. Accounting principles. Accounting principles are the set of rules and guidelines adopted by organization for preparing comparable financial statements. Through precise guidelines, the information presented is accurate and precise. So these are the accounting principles are certain rules or customs which are followed by the company for preparing the financial statements. Okay, so let's discuss what are those. Normally, accounting principles are classified into two. One is accounting concepts and another one is accounting conventions. Okay, somewhere you may find the complete list of the accounting principle, and somewhere you may find the accounting principles are classified as concepts and conventions. Okay, so first we'll discuss accounting concepts. Accounting concepts is an assumption that serves as a foundation for preparing final account and recording business transactions. So these are basically assumptions on the basis of which financial statements of a business are prepared. So these are some assumptions or assumptions and conditions which has been followed by the company for preparing the financial statements. Okay. Now there are different types of accounting concept. First concept is business entity concept. This concept refers to the assumption that a business enterprise is independent of its owners, meaning that an action taken of a business doesn't affect its owner. This concept is also called as separate entity concept. It means, for example, one person is Rohan and he opened a business called as Rohan Limited. So these are two different entities. One is Rohan and another one is Rohan Limited. Okay. So when here Rohan is investing money in the business, so he is giving money in the business, that will be the capital for Rohan Limited, and it will be recorded under liability head. Okay, liability head, you will understand liability later. Liability basically which the company has to pay back. So it's Rohan money, it's not Rohan Limited money. It's Rohan money which has been invested in Rohan Limited. It's become a capital and a liability for Rohan Limited. Same, and any expenses which is personal expenses of Rohan cannot be recorded in Rohan Limited. Okay, like for example, household expenses, house rent, anything. So that can't be recorded in Rohan Limited. That is the expense of Rohan. I hope this is separate entity. So you cannot merge owner and the company as one. Okay, that will be different. Next concept is accounting cost concept. Okay, to record transaction, accounting write the cost of the purchase amount regardless of its actual amount to avoid recording arbitrary values. Simple words. For example, accounting cost concept says that like for example, there are fixed assets like land and building, machinery. Okay, so it will be recorded in the book on the cost of acquisition, on cost of purchasing, not as market value. Okay, not as market value. This is accounting cost concept. It simply says record the asset at the price you paid for purchasing or you paid for acquiring, not as a price, not at the market value. Okay, so this is about the accounting concept. Next, we'll discuss dual aspect concept. Okay, this is believed that every transaction affects two accounts, which the receiver and the giver, or it simple means every aspect of the transactions will affect either asset, liabilities, or capital, or it can be asset. Okay. This concept assumes that every transaction has a dual effect. That is, it affects two accounts in their respective opposite sides. Okay. So any transaction you are recording, it will affect at two places. For example, purchase goods on credit from Arun. Okay. So one debit aspect is purchase. That means your asset is increasing. And credit aspect is Arun, he is the giver. That means your liability creditors that you have to pay on. One is asset is increasing and liability is also increasing. You can take another example. Purchase goods cash. Purchase goods for cash. So here only asset is increasing, that is your goods purchase is increasing and cash is decreasing. Okay. So this is dual aspect. Any transaction which will affect two accounts. I hope it's clear to everyone. So the accounting equation is asset equals to liabilities plus capital. So whatever is the total of the asset is always equals to the total of liabilities and capital. Capital is the amount which is being invested by the owner and liability is the amount which the owner has to pay. Okay, so that's why asset is always equals to capital plus liabilities. Next concept is going concern concept. Going concern concept means that a business firm will continue to carry on its activities for an indefinite period of time. Okay, so when a working with companies, accountant assume that a company isn't going bankrupt unless there is evidence to state otherwise. That means today is recording transaction, it doesn't mean tomorrow the company will get closed. So it has been assumed that the business or the firm will be working for the indefinite period. Okay, so this is the going concern concept. Okay, next is matching concept. Matching concept, during a given accounting period, accountant matches income and expenses to measure profitability. So if income is more than expense, it is profit, and when income is less than or expenses are more than income, this condition is called as loss. Okay, so matching concept states that the revenue and the expense incurred to earn the revenues must belong to the same accounting period. Now here it should be of same accounting period. Okay, so you are matching all the incomes of same accounting period and all the expenses of same accounting period. If the income is more than expense, it is profit, and if the expenses are more than income, then it is called loss. I hope this is clear. Next, we will discuss money measurement concept. Money measurement concept means the accountant only record monetary terms values in the books and are less concerned about other factors. Here means the transaction which have monetary value will be recorded in the books of accounts. The things which do not carry any monetary value will not be recorded. For example, purchase goods for rupees 20,000 will be recorded. Okay, machinery purchase for rupees 1 lakh, that will be recorded. So the transaction which can be measured, salary paid, commission paid, any expenses or anything you are paying which you can measure in terms of money, that will be recorded. But the things like that is also important, like sincerity, loyalty of the workers, it is also important for the business, but that is being not recorded because we can't measure in the monetary terms. So transactions which can be measured in monetary term will be recorded in accounts, books of accounts. Those transactions which do not have any monetary value, that will not be recorded. Okay, next we will discuss about periodicity concept, that means accounting period concept. Okay, so accountant bodies record financial statements at the end of every period or financial year. Okay, so here all the transactions are recorded in the books of account on the assumption that profits on these transactions are to be ascertained for a specified period. Specified period means it can be 3 months, it can be 6 months, quarterly, half-yearly, it can be 1 year. So the transactions related to, like for example, we are calculating the condition for 6 months. So all the transactions related to 6 months will be recorded, income and expenses, assets and liability, to identify the profit condition or loss situation, as well as financial position of the business and tax calculation also. So periodicity concept says that the transactions recorded for certain period. So in every year it is for 1 year. Okay. Next concept is realization concept. When recording transactions, firms record the transactions only after they realize the total amount received. For example, realization concept means you received an order for rupees 50 lakhs. Okay. But you deliver 20 lakhs goods in this financial year. Suppose it takes the financial year 2023, and another 30 lakhs will be delivered in next financial year, that is 2024. It means the total revenue or the total sales for the 2023 will be 20 lakhs, not the 50 lakhs. You have received the order for 50 lakhs, but actually the actual delivery you have done 20 lakhs for 2023 and 30 lakhs for the 2024. So here 50 lakhs will be not recorded as revenue for 2023. For 2023, the 20 lakhs will be recorded, and for another 30 lakhs will be recorded for the year 2024. I hope this is called realization concept, when it is being realized. Okay. Now here, like suppose you have delivered the good, you made the sale in 2023, no matter when you receive the payment in 2023 or 2024. Okay. If you receive the payment, it will be cash sale. Otherwise, it will be a credit sale for the 2023. But the sales done in 2023, that will be 20 lakhs. Either it is cash or credit. I hope it's clear. Next is accrual concept. Accrual concept, a transaction is said to be accrued if a transaction is recorded at a time when it takes place and not at the time when the settlement takes place. For example, you made a sale for rupees 20 lakhs and you receive 15 lakhs now, immediately now, and another 5 lakhs you received in after 6 months. Okay, so this is called accrual concept. So total sale, it is done 20 lakhs today. So 15 lakhs you receive today, 5 lakhs you will receive after. For example, December you have to pay salary, but you don't have money and it's become outstanding. That means you have to pay later. But this salary will be considered for the December month, no matter you pay in January or Feb or any time you pay. But this will be considered expenses for the month of December. This is called accrual concept. Transaction is recorded at the time when it takes place. At the time when it takes place, no matter when you are paying it. Okay. So this is the meaning of these. Okay. So these are the concepts, accounting concepts, which is being followed by the company for preparing the financial statement. Now next we'll move to the accounting conventions. So accounting conventions are the guidelines, or these are the customs and traditions which is being followed for the preparing the transactions or statements. First convention is conventions of conservatism. Conservatism means when providing estimates for liabilities and assets, accounting takes precautions and makes safe actions, considering the worst case scenario of the financial future. Worst case scenario means loss. Profit is always good. Okay. So you are recording here, you are anticipating all losses, all possible loss. You're not anticipating all possible profit. You are anticipating all possible loss. So for this, like bad debts, is become bad debts. Okay, there is no word called good debts or anything. Okay, bad debts, that means the debtors which default for making the payments. So that is called conservatism principle. Next is called consistency principle or conventions of consistency. To keep things reliable, accountant use the same accounting principle across accounting cycle. This make it easier to assess how the company performed in one period compared to another, since the principles are same. So whatever method you are practicing, that method should be followed for all the years. So it is easy to compare the financial statement of the company. Like suppose in one year you are following different practice, in a second year you are following another practice, third year you are following another practice, then it's very difficult, becomes very difficult to compare the performance made in year one, performance made in year two. Okay, so that's why consistency, convention of consistency means whatever principles or things we are followed in year one, same should be followed for two and so on years. So to come at better conclusion. Okay. Next principle is conventions of full disclosure. In order to make decisions with all the facts, accounting bodies share all the information considered important, even it is detrimental. Whatever transactions or information related to the business should be disclosed, full disclosed. Even the transactions which may bring loss or loss transactions or any which is not good for the company, that transaction should also be disclosed. Okay, we should not hide any transaction. Next is materiality, conventions of materiality. As a part of decision making process for reviewing financial statement, companies share information such as an item or event that is material. Material means important and relevant information should be supplied to the user of the accounting information. User of the accounting information here means top management, tax consultant, who are using the information. It can be investors. All material information should be informed to all those who are the users of the company. Here material fact means information which influence the decision of the user. So here if the top management should know every transaction, every record of the business, because based on that the management will take the decision. Tax consultant also know what is the sales, whatever transactions you made during the year, so he can conclude for the better tax. Same way investors should know all these information so they can make a wise decisions. So these are the accounting conventions. Okay, so I hope you like my video. Still, if you have any doubt, you can message in the comment section. See you next video. Thank you.